Hello everyone, it is 10 o'clock now, so we will get started on our presentation today. Thank you for joining us, first of all. This is a presentation that I did at the WCS conference in Scottsdale, Arizona this fall, and it basically runs through some of the changes in the budget 2018. It talks a little bit about the insurance changes that resulted Jan 1, 2017, and how that's actually impacting our business today. So hopefully you'll find this informative. It is certified for continuing education credits, so you will get 1 CE credit for this presentation today if you were not in Scottsdale. Unfortunately, we're only allowed to take credit for it once. If you have any questions, please feel free to use the chat function inside Skype. We won't be able to deal with them as they come up, but we might be able to deal with them at the end, time permitting. And if that's not possible, then I'll certainly get back to you and answer your questions, and we can have a discussion at that point in time. So let's proceed. So as we've all noticed in Ontario, certainly, the traffic circle has been popping up everywhere. These are 2 new traffic circles in Kitchener. They have been put in place here just in the last 9 months. It's actually surprising how fast the various municipal facilities can install these things now. And the point of them is really just to increase traffic flow at peak times, whereas traffic lights make everybody stop. If traffic's moving properly, you can move through a traffic circle much faster. This is an aerial view of a traffic circle, the first one I think I ever saw. This was in Moncton, New Brunswick. I spent 10 years in Moncton with one of the major carriers. To give you an idea of the size of this traffic circle, that's labeled off to the right, CF Champlain, that's actually Champlain Mall. So that is a full-size mall. That traffic circle is actually about 400 meters in diameter. So it's about 1.25 kilometers around in circumference. Kids use that as a racetrack at night in Moncton. It was the largest one that I've ever seen, certainly in Canada, it was an interesting experience. Next up, I have a little video on what they call the magic circle in Swindon, England. I don't know if anyone has ever seen this or not. Now, unfortunately, you're not going to be able to get to listen to the audio. I'll play it and provide some commentary for it. We'll provide links to any of this if you want to see it. But this is 7 traffic circles combined into one. So this roundabout has been in place for 60 years, and it is actually 7 traffic circles built into one. So 7 roundabouts in one. In a normal roundabout, traffic moves in one direction. In Swindon, you can actually go in multiple directions, and you can move from point A to point B without going all the way around the circle. So to get to any one place, you can use a different route. This is what it could look like in rush hour, which is kind of crazy. I'd be interested to know anybody on the call today who has actually driven through this. So with this process, you enter the traffic circle, yield to traffic already in there, and then exit. So Swindon actually claims to have only had 1 fatal accident in the past 5 years. So in this particular video, to celebrate a town anniversary, they paraded 60 classic vehicles through here. So, is this magic? No, that's Swindon. So to give you an idea, you can just imagine trying to explain to somebody new what it would take to drive through Swindon. In a lot of ways, what we do every day in trying to interpret tax law and working with business owners, I mean, it's the same issue. It's difficult, but not impossible. This was an interesting little comic that I found when I was putting this presentation together. You know, it's clear that the government is taking a look at small business and figuring out if they can access tax dollars anyway, or any easier way and sooner than what they have been before in the past. But to be honest with you, I mean, your average entrepreneur, the small business owners in Canada, have not just laid down and been quiet. They've been making some noise, and they have certainly presented their views to government. So let's take a look at Budget 2018, do a little background, and talk about some of the things that have changed. So as we all know, Canadian taxation is based on a theory of integration, where income should be taxed the same regardless of how you earned it. So if you earned it personally or through corporate activities, it should be taxed the same at the end of the day. It's the timing issue that becomes important here. So with the globalization of the world economy, the government's worked to encourage entrepreneurs and professionals by providing tax benefits for Canadian-controlled private corporations and professional corps. So the goal has always been, as publicized, innovation, job creation. We're trying to create more employment, more opportunity for Canadians. As we all know, small business represents a very large share of the GDP of this country. I think well over 50% at this point in time. So entrepreneurs take a lot of financial risk every day. I think we can all agree on that. And they have endured some pretty significant business turmoil in the last 30 plus years. High interest rates in the late 70s, early 80s, opening of the borders to trade, so NAFTA, etc. And, you know, now we've got Trump and Trudeau and what they're doing inside our various countries. You know, but the current government is concerned about what they consider abuses of the system. So this is a system they created over the course of many years, but they think that we're abusing the system from the standpoint of what we're doing inside their rules. So they're looking at changing some of the rules. So some of these abuses, as they see them, are income sprinkling inside the family. So this is where we're using a corporation to spread the income around, and every individual inside the family is in a lower tax bracket, so we're reducing the amount of overall taxes paid. Multiplication of the lifetime capital gains exemption, again through the corporate structure. Conversion of dividends into capital gains through complex transactions. I won't get into that today. That could be a conversation, an hour on its own. And then for the biggest issue that they're addressing is what they see as abuses on the passive investment income in a private corporation. That's mostly what we're going to talk about today. So when it comes to passive income, ultimately, whether you earn the income personally or corporately, the tax rate is the same. That's the goal anyway. That's the integration of the Tax Act. But if you earn income in a corporation, you can defer tax on those retained earnings until you take them out as a dividend. Investing those lower taxed retained earnings inside the corporation gives you more initial capital to invest. And it's a compounding factor. The more you have to invest, the more investment earnings you're making, and the number grows faster in an exponential fashion. So, for example, if you take $100 of income personally and you're in a 50% tax bracket, you have $50 to invest. But if your small business earns $100 and you're only paying 15% tax on that $100 of earnings, you have $85 to invest at that point. That extra 35% is typical of the average tax deferral for a small business corp in Canada. So, and the government doesn't like this, and they were proposing rules to tax the income on that 35% additional capital at rates as high as 73%. So these were the initial proposals that came out from the government before the budget of 2018. So when we take a look at it and take a look at the distribution of passive income in Canada, as you can see, the vast majority of small corporations in Canada don't have any passive investments. I mean, 84.5% of the corps in Canada, this is as of 2015, had no passive investment income inside those corporations. If you look at the other end of the spectrum, I mean, for those that have over $2 million of passive investment income, that is a larger number. All right, so there is the vast majority of the passive investment income is in a very small group of corporations. So that's 1.6% of the corporate population has 80% of the passive investment income. So when you take a look at the taxable passive investment, so the top 1% of the corps have 83.4% of the passive investment income. Now, they're likely paying the highest marginal tax rate anyway at this point in time, because under the small business rate rules, I mean, you can only have income inside the corp up to 500,000. So I'm guessing that a large percentage of that top 1% are paying higher marginal tax rates. They're not getting the reduced small business rate anyway. So 97.1% of private corporations have $1 million or less of passive investments. 1.3% have $1 million to $2 million, and 1.6% have $2 million plus. So that's 80% of the passive investments inside private corporations in Canada. So what the government approved at the end of the day, after they went through consultations with the industry and small business in Canada, they put in a $50,000 passive investment threshold. So they made the assumption that if you have $1 million of assets at a 5% return, you're going to make $50,000 of passive income. So anything under that is going to be taxed at the normal small business rates. So in that situation, so $1 million of assets or less, there's really no change in this particular situation. And basically it ends up being a sliding scale. By the time you get up to $150,000 of passive investment income, there's going to be zero corporate income eligible for the small business rates. So you're going to be paying the normal corporate rates in Canada. So to give you an idea of what that would look like, so at 50,000, as I said, there's no reduction in the small business limit. As we go up to 70,000, the reduction in the small business limit is 100,000. So you can have up to $400,000 of income taxed at the normal small business rates. So as you can see from the graph, at the 150,000 of passive investment income earned inside the corporation point, then none of the business income is going to be eligible for the small business rate. This is a very interesting chart that I found from BDO, and I think it does a great job of really explaining what the government was attempting to do in limiting the tax deferral that's available through a corporation. So if you take a look at scenario number 1, this is basically the new rates under the proposed changes. So scenario 1 is the old rate, scenario 2 is the new rates. So if you'll take a look there, so look at total corporate tax rate. So it's labeled C there. Under scenario 1, the old rules, the corporation would have paid $55,000 in tax at that point, and whatever money you left inside the corporation would add to your passive investments inside the corp. Under the new rates, the corporation has actually paid $80,000 more in tax. So this is on the same income level, all right? And this is the difference between a corporation, scenario 1, having passive investments of $50,000, so no impact, and a corporation having $150,000 of investment income. So they have no small business deduction rate. So there's an $80,000 difference between those two corporations on the same amount of corporate active business income. So this is $500,000 of corporate asset income. Now, as you work down through the math, as you go down through, you pay out a dividend, pay your taxes at a personal rate. So in this particular situation, second from the bottom in that chart, you'll see combined corporate and personal tax. In scenario 1, it's $245,000. In scenario 2, it's $250,000. That's really only a difference of about $6,300. So the net proceeds to the individual shareholder is about the same. I mean, there's a $6,000 difference, but it's the timing issue that's important here. So if that particular shareholder was going to leave the money in the corp, they would much rather be falling under scenario number 1, where they have a lot more money left inside the corporation because they've paid a lot less. They've paid $80,000 less corporate tax. than under scenario 2. So this is all based on Alberta rates. This was the example that BDO put out, but I think it does a really good job of explaining to someone what the differential is here. And it's all based on timing. The government is attempting to get their tax dollars sooner rather than later. So they are limiting the amount of deferral on those corporations. So the proposed clawback of the small business limit is based on the amount of investment income, not on the amount of small business income in the corporation. So this is another interesting point. If a corporation has, say, for argument's sake, $150,000 of business income and $75,000 of investment income, the clawback would be that mathematical calculation, or $125,000. This will reduce the small business limit from 500 down to 375,000. Since this particular corporation only made $150,000, all $150,000 is still eligible for the small business rate. So in this situation, even though the small business owner has $75,000 of investment income, and he does fall underneath the new rules, at the end of the day, because the corporation only made $150,000, it doesn't even impact him. It has zero impact in this particular situation. So while the media has certainly been doing a good job in trying to get the information out, there's a lot of caveats that you need to understand. In a lot of cases, I really don't think that these changes are going to make that much of a difference for your average entrepreneur, small business owner in Canada. So these passive investment rules all come into play Jan 1, 2019. So for this year, we're still working underneath the old rules. All of these new rules from the budget 2018 are coming into play Jan 1, 2019. So I would argue that we still have a little time, not a lot of time, but certainly have a little time to identify those clients that we have in our database at this point in time, small business owners in the $500,000 of income or less window, professional corps and entrepreneurs. Identify them and start talking to them at this point in time to see whether or not they've been talking to their accountants and whether or not they've made any changes or have thought about making any changes in their investment portfolio if they have one inside their corporation. So other changes. Now, as we all know, we had a fairly significant, or it sounded significant, life insurance changes, legislation changes. They all came into play Jan 1, 2017. This took about 10 years of discussion. So this has been between the government and the industry. Insurance, as you know, is provincially legislated, so all of the provinces had to be on side. So after 10 years of discussion, they were able to come out with some new rules. And this was mostly around the MTAR calculations, the exempt test calculations. The government felt that there were a number of inconsistencies, which there definitely were in the industry. There's no question. The last set of changes that came about were put in place before universal life was even available inside our industry. So just taking a look at the universal life business on the books in the last 20 years, a number of carriers have administered the exempt test differently, the ACB calculation differently. So in a lot of ways, this change that came about is to standardize it across the carriers so that no two carriers should really be looking at any of the math differently. So it's the first major reform since '82. It has a very minimal impact on personally owned life insurance. It really impacts the corporate world much more than the individual. For the most part, it's actually a good thing for personally owned life insurance because under the new rules, the chances of you making a withdrawal on a tax-free basis under the new rules is greater because they are actually keeping the adjusted cost base higher longer under the new rules. Now, on the flip side, that's a bad thing for corporations. So it was clearly an attack on small business in Canada, in my opinion. They were going after the Canadian controlled private corps and professional corps. out there because it significantly reduces the capital dividend account credit that's available for insurance purchased at older ages. And I'm going to talk a little bit about what the impacts have been on that capital dividend account. In the 2018 budget, the income splitting rules did not change. Those actually came into effect Jan 1, 2018. So in a brief summary, the tax on split income now applies to dividends paid to family members, except where they are the business owner's spouse, provided the owner meaningfully contributed to the business and is age 65 or older. So these are the rules that you need to satisfy in order to be able to split income. You know, the individual has to be 18 years of age or older and make regular, continuous, and substantial labor contributions to the business during the last 5 years. So putting your child on the payroll and paying them whether or not they show up for work is not going to work in the current plan, and this was all effective Jan 1, 2018. So, and if you're age 25 or older and own at least 10% of the corporation that earns less than 90% of its income from services and isn't a professional corporation, then you're not going to be able to split income. So those rules have been in place. I think a lot of our business owners have talked to their accountants about that. They know what they need to do on that side. I don't see that there's a tremendous opportunity there for us to provide any help at that point. That's going to be mostly an accounting issue between themselves and their accountant. So budget 2018, it was definitely not perfect, but it was much simpler than was previously proposed. The proposed system was a very convoluted system of reducing refunds on investment taxes. It was going to require long-term tracking of previous investment assets inside a corp versus new investment assets as of a time frame. You know, the existing retained earnings in the corporation don't have to be tracked separately now from future earnings. And that has greatly reduced what would have been an accounting nightmare. So as I said, it applies to 2019 subsequent years. And basically, in quick summary, once your passive income exceeds $50,000 a year, your small business deduction limit drops by $5 for every $1 of passive income. It's simple math. And as we all know, likely, the small business tax rate is dropping to 10% in 2018 and to 9% in 2019. So on one hand, the government's saying they're trying to promote small business in Canada, and at the same time, they are going after what they consider some loopholes. Now, as I said in a previous screen, when you take a look at the number of corporations that are actually going to be impacted by this new passive investment tax change, I really don't think it's a big number. I think in a lot of cases, most of the corporations that we're working with, most of the business owners we're working with today are not going to be impacted by this. And, you know, really, I don't think the government is going to succeed in what they're trying to do, quite frankly. So when we take a look at the second passive investment measure, this is really not going to impact most of the business owners that we're working with. You know, they changed some refundability of taxes on the investment income, limited the tax advantages of large Canadian-controlled private corps that can access refundable taxes on distribution of certain dividends from business operations. So currently, Canadian-controlled private corporations can get refunds and taxes paid on passive investment income when they pay out eligible dividends from business operations, which is not the government's intent. So the proposal to tie refunds to investment taxes paid only when non-eligible dividends are paid. This begins in 2019. As I said, I don't think this is going to be a significant issue for most of the people we're working with. So really, what does that mean? So now that we take a look at it, so for passive investments in a corporation where they're over $1 million, they're just getting into the point at which they're going to start reducing the small business deduction rate. What can we do? So you can keep the investments in the corp, pay the higher tax on operating income, so the decreased small business deduction. We can dividend out the passive investment capital and pay tax personally. That's what the government would love us to do, because that effectively crystallizes their tax at this point in time. And that is essentially the goal of the government. They're trying to get access to their tax dollars sooner. Third option then would be find an investment with some or 100% deferred growth inside the corporation. Now, Maureen Walker actually talked about this in Scottsdale when we were down there this fall. There are some products out there that have tax deferral. It's not taxed on an annual basis. The Desjardins market-linked GIC would be one of those products. And then you've got your corporate class funds. So these are very tax-efficient products. They are not incurring a large amount of investment income on an annual basis. They're trying to defer that as much as possible. So those types of investments inside your corporations are going to be one of the options. And then, of course, coming from the life insurance guy here at WCS Bridgeforce, I would argue that we still need to look at life insurance. So even with the 2017 changes, life insurance is still the best way to tax efficiently utilize and ultimately extract the retained surplus from private corporations. So nothing has really changed. Some of the changes in 2017 have resulted in the fact that we maybe cannot put as much money into some of these contracts long term as what we have in the past. But for most individuals that are doing 10 to 15 pay contracts, you can still get as much or more money into these contracts, which are growing on a tax-deferred basis, than what you could prior to the changes in 2017. So this is a good news story. I mean, we are extremely fortunate in the life insurance industry to have a government that realizes that life insurance is a good thing. It's a good thing for society. It's a good thing for businesses. And they've put in place rules that are very preferential for us. I mean, all of the growth inside those contracts, up to the exemption limit, is growing on a tax-free basis. There's no annual taxation, and it all is coming out tax-free at our death. And it's an asset that we can use during our lifetime. We use that concept on a very regular basis. Your corporate insured retirement program, your immediate finance arrangements. There's a number of things that you can look at to use these assets during your lifetime. It's not just for life insurance coverage at the end. Now, with the changes made Jan 1, 2017, there are some timing issues. We need to start planning much sooner now if you want to maximize the benefits of permanent cash value life insurance inside Canada. It's not a massive change, but you definitely have to start sooner than what we could have done in the past. So what have we learned post Jan 1, 2017 as far as the insurance side goes? So we moved to new mortality tables, and basically under the mathematical calculation, the NCPI, the net cost of pure insurance, is now smaller. That's because we're living longer. So the actual cost of the insurance in each year of our life, so for a 45-year-old male, the cost of insurance is lower now than what it was previously. The mortality table that we were using previously was from the early 70s. So under the new rules, the net cost of pure insurance grind is now slower. So ACBs, the adjusted cost base, stay higher longer. So where this really comes into play is our corporate situations, because as we all know, capital dividend account, CDA, is equal to our death benefit minus our adjusted cost base. So in the past, and still currently, ideally we want our ACB to fall to zero as fast as possible so that it results in a complete and full capital dividend account credit in the corporate world when one of our insureds passes away. So in that situation, all of the capital dividend account can be paid out of the corporation on a tax-free basis through a capital dividend declaration. So with these changes, so ACB staying higher longer, it's a great thing for personal plans. It's a bad thing for corporations because it's reducing the amount of capital dividend account. We're still getting the death benefit in our corporate scenarios. So you're still getting the dollars. It's the CDA amount, the amount that you can get out of the corporation on a tax-free amount, that has changed. So when we take a look at how the new grids work, in order to get a full capital dividend account credit, this is assuming level COI, pay life scenario, a individual age 40 will have a full CDA, so that means the adjusted cost base is ground to zero by around age 89, which for most 40-year-olds is going to be pushing right around life expectancy. At age 50, your ACB is ground to zero around age 90, which for most of us statistically is going to be beyond life expectancy. At age 60, the ACB is not going to grind to zero until age 94. Now, the big caveat where we see a lot of business being written, certainly in our market, in the business owner market, they've gotten to the point, they've done well inside the corporation, they're typically age 70 plus, and they're looking at what their options are from an investment perspective and passing wealth on to the next generation in the most tax efficient manner. So most of that insurance being written at age 70 and above now will not see full CDA credit because the ACB does not grind to zero until around age 105. And at this point in time, I mean, we're just not statistically living that long. Medical advancements aside, your average person is not going to make 105 years of age. So this is why I say you need to start looking at your permanent insurance earlier in life for our business owners, because if we wait until age 70, we're just not going to get all of that money out of the corporations through the capital dividend account calculation, because the ACB is going to end up being positive. It's not a bad thing from the standpoint that the corporation will have the money, but you're not going to be able to get it out without paying some tax. So the differential there, the amount that does not come out as CDA, if you dividend that out, you're going to pay your normal dividend rates on it. So in looking at this, there is a huge opportunity. And one of the other points too, with regards to the changes Jan 1, 2017, is that the type of product that you're selling now makes a difference. So in the past, it really didn't make any difference if you're selling level COI, whole life, YRT, yearly renewable term. It really didn't make any difference to the calculation. That has all completely changed as of Jan 1, 2017. So as you can see from this graph in front of you, at the younger ages, it doesn't matter what product version you sell, whether it's short pay whole life or life pay UL. They all end up resulting in ACB grinding to zero and 100% payout to CDA. And in this graph, I'm assuming a life expectancy of age 85. That is not the life expectancy of a 30-year-old and a 40-year-old and a 50-year-old. It actually is based on, as you get older, you have a chance of making a later life expectancy. But I had to keep this as simple as possible in order to put it into a graph. So I'm just assuming life expectancy at age 85. So on that basis, you can see as you get older, it becomes blatantly clear that the products you're selling, if your goal is capital dividend account and getting money out of the corporation tax free, you need to look at the other products out there. All right. So now one can argue that policy face amount growth in the short pay whole life contracts will help offset a decrease in efficiency. And that's really all this graph is showing you, the efficiency of CDA. You know, I'd argue that growth with poor CDA percentage payout is just poor planning, because we can take a look, and as you can see, for your male age 70, I compared the 10 pay whole life CDA to what that same premium would buy in a maximum face level death benefit yearly renewable to age 100 contract. The YRT contract has twice the capital dividend account and more total face amount than what the whole life contract has. So as we've all seen, there's been, you know, a huge uptick in the amount of whole life being sold in the marketplace. There are definitely some very valid reasons on selling a growing death benefit, growing cash value whole life contract. And some of those concepts would be, say, your corporate insured retirement program, where we're trying to get money out of the corporation. CDA efficiency may be secondary in that situation. But if the goal is capital dividend account, and that is the only goal, if there is no concern about cash value at the end and the ability to access that, and cash value is a huge opportunity for us. I talk about cash value permanent life insurance all the time from the standpoint of using it as long-term care coverage. You can borrow against that cash value if you need it. If you don't need it, then your family is basically going to benefit from it long-term. So that seems to make a little more sense to me in some cases than some of the long-term care options that are available out there. But I mean, as you can see, your pay life yearly renewable term to age 100 contract ends up being the most efficient CDA contract. But there are still many valid reasons for looking at some of the other options. So even though the math on them doesn't work from a CDA perspective, they still make sense from what the client is trying to accomplish. In all cases, I'm more concerned about what it is that the client is trying to accomplish than any one carrier or product at the end of the day. I need to understand what the client's goals are in retirement and at the end, what they want to have happen before we can make any recommendations. And there are a number of different products out there that you need to take a look at, not just look at the one particular contract, that being whole life at this point in time. I would argue most of my corporate sales where CDA is a primary concern are ending up being fully guaranteed YRT to age 100 contracts. So obviously, what's my point? It makes a big difference if you're concerned about CDAs to which contract you're selling. So if you're creating a corporate asset that you plan on borrowing against during the lifetime of the contract, and the whole life contract certainly makes sense. Depending on what the goal is, there are many situations that I'm finding right now where YRT can far outpace and exceed some of the other whole life options out there, and they're doing them on a fully guaranteed basis. I'm not taking investment risk inside my YRT contracts that I'm illustrating at this point in time. You know, will that change in the future? When interest rates come back, I think the YRT contracts are going to end up looking that much better versus some of the whole life that's being sold in the industry right now. But again, it depends on the goal. There is nothing wrong with a growing whole life cash value death benefit contract, and it just depends on what it is that the client is trying to accomplish. So once you know that, then it's easy to make some recommendations. In my day-to-day activities and talking and working with brokers in the field, this next topic comes up on a very regular basis. And I thought I'd address it in my presentation in Scottsdale because there does seem to be some confusion around this issue. And I mean, I've had some very lively conversations with brokers before in the past as to how this works. And in some of those cases, they were very adamant that that is not the way it was, but I'm here to tell you that the government is looking for tax dollars, and they are certainly looking at this issue. So when we transfer the ownership of life insurance, and a lot of times this scenario comes up where you've got a business owner. He's maybe had a permanent insurance contract inside his corp, or he's got a large buy-sell term plan and wants to convert it out to himself personally. You know, under subsection 148(7) of the Act, you have a taxable disposition when you transfer a life insurance contract. So this is in a non-arm's length scenario. So where the cash surrender value is in excess of the adjusted cost base, that is taxable to the corp. So this scenario is where we're transferring from a corporation to the shareholder that controls the corp. So this is the owner of the corporation. All right. So in that situation, so let's say we have a $100,000 cash value, the ACB is 50, you've got a $50,000 taxable gain to the corporation. So is that the only taxable gain we need to be concerned about? All right. Well, the answer is not really, and it depends. Okay. So under tax integration, you know, CRA eventually wants their 50 cents of every dollar profit earned in Canada. Let's be honest, that's really how it is. So, and actually it's a little closer to 53 cents of every dollar of income. At the end of the day, after all of the money ends up in your personal hands. So again, it's just a question of timing. It's going to be early or later, and trying to defer when we give the government our tax dollars is why we're using Canadian controlled private corps. So if I'm the principal shareholder and take a life insurance policy out of a corp without compensating the corp for that policy, what are the tax implications? For many, many years, most of us in the industry would have said none. The corp is paying their tax on that taxable disposition, and after that, there's no taxes. Well, that's actually not the case. It depends on the situation. So post March 21st, 2016, transfers to owner employees or shareholder or employees, the proceeds of the corp are the greatest of the value and the interest of the policy, so that's the cash surrender value, fair market value of the consideration paid for the policy. Now, in most cases, the business owners are not paying the corporation anything for the policy, and the adjusted cost base of the policy. So that generally ends up being the cash surrender value. So that's the value to the corporation. So taxable shareholder benefit. So subsection 148 deals with the acquisition and disposition of life insurance policies. It does not eliminate the potential taxable benefit conferred on the shareholder or the employee as a result of the transfer of ownership. The taxable benefit issue must be considered when contemplating a transfer of a corporate-owned insurance policy to a shareholder or an employee. CRA has consistently held that a shareholder benefit under subsection 15.1 or an employee benefit under paragraph 6.1a will be taxed in the hands of the transferee to the extent the fair market value of the insurance policy exceeds the amount of consideration paid for by the shareholder or the employee. And there's a technical tax interpretation from January 13th, 94, if you really want to go take a look at that. But the assessment of a taxable benefit is similar to the treatment when any asset is transferred out of a corporation. So, in order to avoid the assessment of a taxable benefit, the shareholder or employee should pay consideration to the corporation equal to the fair market value of the life insurance policy. So, what is the fair market value? Well, CRA actually goes through the process of explaining to us what we need to do in order to determine what the fair market value is. And these are the points that they take a look at. So they take a look at the cash surrender value of the plan today. They look to see if there's any policy loans against the plan. They look at the face value of the policy. They also tell us that we need to take into account the state of health of the life insured and his or her life expectancy. For term insurance contracts, we need to look at conversion privileges and then look at the other policy terms, term riders, double indemnity provisions, etc. Those are typically a pretty minor aspect to it. And then the replacement value of the policy. So in applying these general valuation principles, you can produce a fair market value, which is typically significantly in excess of the cash surrender value of the policy. If the general valuation principles apply, the fair market value of an interest in life insurance may approach the total death benefit if the death of the life insured is considered imminent. The taxable benefit to be included in the shareholders' or employees' income will be the excess of the fair market value over what they paid the corporation to get it. So, to provide a working example of what this would look like, let's talk about a couple of scenarios here. So, case one, I have a male age 40. He has $5 million of T10 inside his corporation. Policy's 3 years old. The cash surrender value is zero, obviously. It's a term plan, has no cash values. This individual just qualified on a preferred basis 3 years ago. He has no health issues. Nothing's changed. Had no driving infractions. There's no other issues here. He could go out and buy new coverage today. So what's the fair market value of that plan? Arguably, that plan is essentially on its own not really worth anything because that individual could just go out, apply for new coverage, and get the $5 million of coverage anywhere at any carrier with no issue. So really, that plan agreeably would have a fair market value of zero. So now let's ramp this up a little bit. So now we've got a male age 60, again, another $5 million of T10. Policy is 8 years old. Still have zero cash surrender value because it's a term plan. But the insured had angioplasty 2 years ago. The procedure was rated a success, but he clearly has coronary artery disease, CAD, and will likely require bypass at some point in time in the future. So, in this particular situation, so again, cash value is zero. There'd be no tax implications to the corporation in transferring this to him because there's no cash surrender value, no tax implications. But what would the fair market value of that plan be? So, arguably, he is likely going to be heavily rated if he applies for coverage today. We are now 8 years down the road, so he's 8 years older. He bought this plan when he was 52 originally, so coverage is more expensive. There is certainly no doubt that that plan is worth something because it's a standard risk, 8-year-old plan. It has conversion opportunities. He could transfer that term 10 out to himself personally, convert it at standard rates. He's getting a better insurance rate per thousand than what he could qualify for today. So while there were no tax implications to the corporation, to say that there is no taxable shareholder benefit to him would be a bit of a stretch. There is no chance that CRA would argue that there is no taxable shareholder benefit in this situation. So the only way to really figure out what that plan is worth would be to pay to have an actuarial assessment done. They'll take a look at his health, they'll take a look at what his age is today, and they would determine what it would cost as far as a differential between that plan and what a new plan today at his current health and rated status would be. That differential ends up being your taxable shareholder benefit. So if we go one step further, so again, 60-year-old male, $5 million term, policy is 8 years old, cash value is 0. The insured's been diagnosed with an aggressive form of cancer that's considered untreatable and is not expected to live more than 2 years. So the insured intends to sell the business, transfer that term plan to himself personally, and convert it for the benefit of his family. So what's the fair market value on that transfer? Well, what would you pay for a $5 million term plan that you know you're going to collect on in the next 2 years? All right. It's certainly more than 0. It's not 5 million because you're just going to get the 5 million. But I think we can all agree that there is going to be a number somewhere between 0 and 5 million that you would be willing to pay for that. I mean, if someone would lend me the money, I would likely easily give $2 to $2.5 million for that plan if I knew I was going to be collecting 5 million within the next 2 years. So in that situation, if he transferred the plan to himself outside of the corporation, paid nothing to the corp for that plan, I don't think there's any question that CRA is going to come back and take a look at that. They are looking at large contracts being transferred out of corporation these days. Every time a life insurance carrier transfers a life insurance contract, that is actually reported to CRA. So in this situation, after the transfers happen, CRA is notified that a $5 million term 10 plan was transferred out of this corp to this individual on a direct basis. So I don't think it's a stretch to understand that CRA is going to be coming out here and saying, okay, what did you pay for that plan? If it was 0, show us the actuarial assessment that says the plan is worth 0. And obviously, an actuarial assessment on this plan is going to be easily, I would expect, to be north of $1 million in value, it likely pushing a little closer to $2.5 million. And if he paid no taxable shareholder benefit in that situation, he's going to be reassessed, and there's no question he's going to end up paying tax. I've actually had situations where we've been in this situation. We're looking to transfer the plan out. The client in question likely had under 5 years to live, and we were looking at about a $2 million tax bill in order to transfer the plan to the individual in question from his corporation. At the end of the day, it became a smarter tax result to liquidate all the assets inside the corporation and just keep the insurance contract inside that corp. That corp effectively moved from an operating company to a holding company, and that was the only way to avoid paying the tax on it. So there are a number of ways to look at this, but just be forewarned, some of the carriers do an excellent job of bringing this to your attention. They'll tell you what the corporate tax implications are on a transfer, but they'll also say something to the effect of, but we are of course not in any position to comment on the taxation implications to the individual that is obtaining the transfer of ownership in this particular case. That will oftentimes open the conversation by advisors and brokers in the field as to what that means. And this is exactly what that means. There's that possibility of a taxable shareholder benefit. So what's the moral to the story? Well, it's extremely important to be cognizant of where you put your corporate coverages. All right. We have, for many, many years, all of us know this. I mean, normally speaking, we're not looking to put permanent insurance inside an operating company where we think there's a chance that we would sell the operating company at some point in time in the future. If the intention is to never sell the operating company, then it's not a significant issue. But, as I've always said, never say never. You never know what's going to happen in the future. When I take a look at my largest term insurance conversions every year, most of them are business owners who have had a health event, cancer, heart attack, stroke. They've realized now at this point in time that they are not going to be around forever. They do want to enjoy some retirement. They sell the business. They'll take their buy-sell term coverage, flip it out to themselves personally, convert it, and fund that. But there can be tax implications in those situations, so you just have to be cognizant of that. So normally the holdco is the best place to put the permanent life insurance. Sometimes personally owned can make sense if the client has no holdco, as opposed to the opco. Professional corps can be the exception. I mean, they're only allowed to have the one corporation, so you have to put it inside there. But in a number of the professions that are allowed to incorporate, they are never going to end up typically selling their professional corp. They don't sell the corp. They typically sell their client list. And in those situations, their professional corp really just reverts to a holding company once they've retired. I'm thinking of dentists as a good example of that. They don't typically sell their professional corp when they retire. They just sell their client list. So just something to be to keep in mind when you're looking at where you're going to put your coverage in the future. So in summary, I mean, even under Morneau's changes, I mean, we still have passive investment options inside our private corporations. The government's reaffirmed its intent that we utilize permanent life insurance as part of the plan. I mean, it's clear that life insurance is still the best way to tax efficiently remove excess, surplus, retained earnings from a corporation. That was always the case in the past. That has not changed under the current rules. Now, it may be not quite as efficient as it has been in the past, but if you get to your business owner clients at a young enough age, you're still going to end up seeing a capital dividend account credit that is equal to the full death benefit. But at the end of the day, if you have $1 million death benefit and $750,000 of that is capital dividend account credit, you still have the $1 million cash. 250 of it ends up being taxable when it comes out. 750 comes out tax-free. So you're going to end up netting about, $850 in that situation, tax-free in the hands of the beneficiaries. That's still not a bad result. If anything, maybe we should look at selling larger face amounts now to take into account that differential in the capital dividend account credit. So while we can't predict the government's future tax changes, as you never can, we can't let it prevent us from planning for the future. We still need to sit down with our business owners and make sure they understand what their current options are and help them plan going forward. I mean, tax rules change. Make sure you have some flexibility built into your plans going forward. And that way, when the rules do change, then we have options. I like to talk about option A, B, and C. And in most cases, option A is where we intend to go, but it usually ends up being option B or option C at the end result when it all works out, just because you can't plan for everything going forward, but you do have to make some plans and move forward. You can't just be caught and froze. You have to understand that we have to plan based on what the rules are today, make sure we've got the flexibility, and then move forward. So that basically is the end of my presentation. This last video, I don't know if anybody's ever seen the Red Bull jump from what was he, like 130,000 feet. So this individual with a parachute jumps out of a weather balloon. As you can see, Like he's basically on the edge of space going forward. And he falls for almost 8 minutes before he gets to the point that he deploys his parachute and lands. But at one point in the dive, there is so little air resistance because the air is so thin at this level. He almost breaks the sound barrier. He's running just shy of about 800 mile an hour in the fall. This particular video was brought to my attention. This jump actually happened in 2012. So it's not very hard to find on YouTube. It's just very interesting to see how an individual would even consider doing this, let alone attempting it. And he actually survives. It is something else to watch. You know, the point of this is, you know, this was promoted and it was a joint venture with GoPro and with Red Bull. And I would argue that anybody that owns a GoPro at this point in time is likely uninsurable. I'm just warning you ahead of time based on lifestyle. So I hope you enjoyed the presentation. If you do have any questions, by all means, I'd be more than happy to discuss them. Please either IM them using the chat function inside this presentation or contact me directly. And I'd be more than happy to help you. So thank you. Take care. It is basically end of November already. If I'm not talking to you before Christmas time, I hope everybody has a very Merry Christmas, and we'll talk.